Hi guys, this is Pete here. Welcome back to the channel. So today we're going to talk about will the recent Gaza war cause the market to further crash going into the tail end of 2023 and what you as investors need to watch out for. So let me just go through some quick disclaimer. None of what I'm saying here is financial or investment advice, but it's really me just sharing with you my perspective and my experience in the market for the last 13 years. Okay, so if you look at conflicts, right, although last year 2022 we had a very major conflict called the Ukraine war, but really conflict has never been away from us, right? In fact, we had so much conflict in the past 20, 30 years, and in fact when you look at this, right, if this is from LPL research, when they took all the major and minor conflicts, there's a few interesting points, right? Is that on average the drawdown due to each conflict is about maybe 5%. But more importantly, to me as an investor, is I want to know how long would it take for the market to recover? And the recovery on average, guess what? It's about 47 days. Okay? Now, of course, this is an average number. If you look at some of the details, right? It lies down here, right? The Iraqi invasion of Kuwait and versus the World War II following the Pearl Harbor. This took way more than 47 days to recover. But otherwise, on average, 47 days is pretty much the average. So what's the takeaway here is that unless this thing really get blown out of proportion and become like World War III, then of course we have better things and more serious things to worry about. But otherwise, really this, of course, is not to say that the Gaza conflict is something minor, right? But it could present an opportunity for you as an investor looking at the stock market. Then the question is, other than the current conflict, what are the other things that affects the market? Now, so this is something that is quite funny, right? That we are having a situation whereby good economic news actually being interpreted as a bad thing. Okay, so recently we had the US jobs report coming out at 336,000 jobs being created just in September itself. So this is usually seen as a good thing, but in this case for the US, it's seen as a bad thing because everyone wants the Federal Reserve to stop increasing interest rate. And one thing that they will look at is inflation. But guess what? If you have a strong job market, you are likely to get more inflation, and therefore people feel that, hey, maybe Federal Reserve will continue to raise rates, right? And really after that, the reaction in the bond market was so severe, right? You look at all the 10-year, 30-year treasury, right, all went up in terms of their yield. Okay, so this is how the market is reacting right now, whereby good economic results in the long term is being interpreted as a bad news in the short term. However, I want all of you as investors, including myself, to really focus on the correct things, right? So when we look at the Congressional Budget Office, who gave their statement recently, right? They said this year in 2023, they're expecting a 0.9% increase in GDP. And in 2024, they're looking at 1.5%. 2025, they're looking at 2.4%. So what does this mean? This means that actually, yes, short term, all these concerns about interest rate and whatnot may be hampering the stock market, right? Especially increased bond yield usually has a negative effect on the stock market in the short term. But in the long run, what they're saying here is that you look just 2 years out, 3 years out, we're likely to see better GDP. Okay? And this is really very in line with what I see in the corporate earnings, right? If you look over here, the S&P 500 earnings per share, right, together with the change in price, right now we are seeing a very, very strong recovery in terms of earnings after COVID. Okay, in fact, if you look at operating earnings, it's also showing the same thing, same direction. And in fact, if you look at smaller indexes such as your S&P 400, S&P 600, they are also recovering nicely, right? So it is not just the big companies in the S&P 500, but even the smaller ones, right? The outer universe in the US is also recovering quite nicely as well. Now, with that said, this is the fundamental side. Let's jump into the technical side, right? So if we look at the technical side, I want to look for trends, right? Whether are we going to see a bad technical setup, right? So this is where we are right now in 2023, right? Overall, if you look over here, the moving averages, 45, 55, 70 months, they are all very nicely going up. The only time that is very uncertain in the 2000s is when the averages are all over the place, and of course the market is all over the place, right? And this is something that is not just unique to this era, right? It is never different only in this point. If you look further back, right, starting from 1950, we had a very good run. Only when the EMA once again gets a bit wobbly, that's where you get into trouble. In the 1980s to 2002 is also the same. When the moving averages are all going up nicely, right, it's fine. The only time is when the price really cuts below the moving averages. And over here, we are not looking at short-term moving averages, but we're looking at monthly moving averages, 45 months, 55 months, and 70 months. So what do we see right now is that, guess what? It is very healthy. We are not even close to cutting the whole moving average here. Okay. Now, the next few things that I want to share with you is looking at the big boys. What are they doing? Okay. So if you look over here, let me just erase it first. Okay. Right. This is HYG over IEF. Now, HYG are your corporate bonds. IEF are your 10-year treasury yield. So basically, if the market is in a risk-off behavior, your treasury yield, your treasury bonds will do better than your corporate bonds. So therefore, the chart will be declining. And usually these are so-called pre-signs of collapse, right? You can see these two are dropping, and then later on we had a market downturn over here. Okay, now this is not 100% accurate all the time, of course, but right now you can see that if we just use this as an indication, the appetite for high yield corporate bonds is actually much higher than the treasury. So on the corporate side, on the institutional side, this is actually a risk-on behavior, right? If you look at another indicator, let me just show you again, right? This is S&P 500 divided by consumer staples. Guess what? In a bad economy, that is where consumer staples tends to do way better than the broader market. So over here, you will see that it will be going down, right? And during these periods of going down, guess what? It's also times where we had the market correction, right? So these are things that kind of indicates to you whether the market is on a risk-off, risk-on behavior. And we can see that no matter is it in the bond market or is it in the stock market, currently we are kind of at, not a risk-off situation, kind of a risk-on situation. Okay. Now, with all this said, could there be something that is bad to the market that can happen? I believe so, right? So the only thing that I think can potentially really throw my whole thesis into disarray is if the oil prices continue to push higher due to the fact that we are having a war right now. Okay, you can go and look at the past track record. I don't have it here, but basically whenever we have a war situation, this is where oil prices start to increase, and therefore it will actually bring up inflation. So this is the only thing. But otherwise, if I look at all the other indications, I feel fairly confident that the market is still pretty healthy, pretty strong. And in fact, my own prediction is that we will end the year off much higher than where we are right now in terms of S&P 500. Okay? So guys, I hope this is useful to you guys. Right? If you have any comments, put in down below. If you like the content here, do like and subscribe, and I'll see you next time. Bye bye.